We're continuing our discussion of Chapter 5, and that's the Capital Projects Fund. And we are resuming here with transaction number 7, page 129 of the book. Okay, so the next item is that we received cash that had been promised from the Enterprise Fund, so that comes in as a debit, and we also got $300,000 of cash from the other governmental units. So we're going to write this in as a compound entry with a debit here to cash for $500,000. Okay, the credit is due from other funds, cleans that out, $200,000. Number 7. Gotta get a sharper pencil here. And the other credit is due from other governments for $300,000. Okay, then they issued a bond. They planned to issue bonds to finance this project, and the bond issue took place, and it was sold at a premium. And so from intermediate accounting, you know that when it sells at a premium, it's because the bondholders like it. It's apparently paying an interest rate greater than what the market needs, and the market says, yippee, we're going to bid that up. So the bond, which was denominated at $1,200,000, actually sold for $1,212,000. And so the amount of cash coming in was $1,212,000. So we'll put in here transaction 8, $1,212,000, and the credit is to other financing sources, proceeds of bonds. Credit $1,200,000. That's the face value of the bonds, and then other financing sources premium on the bonds for the $12,000 premium. Okay, and then the 8B is the transfer of the premium amount out of here to the debt service fund. What is that doing? That means that this $12,000 isn't going to be available for slop in the project here. It has to go to pay down the debt, and so out goes the cash to the debt service fund. And we'll watch that transaction when we get to the debt service fund a little bit later. We'll watch that cash come in to that fund. So it was a credit, and then we're going to debit. It's like an other type expense account, other financing uses, transfers out for $12,000. Transaction number 8. Okay, and if there were a discount, they might have to lump it for the difference if there was actually a discount. But anyways, next up, we're going to show the bond anticipation notes payable getting paid off. Okay, we saw something similar to this, remember, in the general fund where we had bond anticipation notes. The note payable is going away, so we'll mark that $100,000 with a debit, clearing out that bond payable. The credit is going to be to cash, but we've got to pay a little bit more than that. There's some interest due on it, so I've got an expenditure there, and the expenditure is actually for the capital outlay. It's an interest charge of $2,500, but it's part of building the building to pay for the interest on that loan. And so the credit to cash now is $102,500. And transaction number 9. Okay, next up, we'll turn the page. The contractor's initial claim is paid, but there's a 5% retainage that's held back. So this is a common thing in a construction project. They send you a bill, and you pay them most of the bill, but not all of it. You hold some back so that they're going to be happy to finish up all the little odds and ends so that they can get the remainder that they're owed. So contracts payable is going to go away, $750,000. We're only going to pay them 95%, and so that's a credit to cash of $712,500. And the remainder is going to be contracts payable retained percentage for $37,500. And that's number 10. How much are we holding back? It was 5%, a 5% retention. So 37,500 is 5% of that $750,000 contract. That's still payable. Okay. Let's see. Next item, disbursements for items ordered at an estimated cost of $217 actually came in at $216,500. So we're going to, for 11, unencumber for $217,000. This is something you got to be real careful of with encumbrance accounts, encumbrances and expenditures. We had specified $217,000 in the orders that we placed. So when we unencumber, we've got to reduce by $217 the amount of the orders. When the orders actually came in, they were a little bit cheaper than we had planned, and so we've got expenditures for the actual amount, $216,500. Okay, and so the debit to expenditures, they tell us was paid in cash, so I've got $216,500 in cash with a credit. Again, I've done that a little bit backwards. I like to do the unencumbrance first and then record the unencumbrance first and then the expenditure with the cash. Okay, the next item, number 12, assume the contractor completes construction of the fire station and bills the village for the balance of the contract. So we're going to unencumber for the remainder of the contract, $750,000, and so that's a credit to encumbrances control, $750,000, number 12, and a debit to budgetary fund balance, reserve for encumbrances. And then we show our expenditures for capital outlays, number 12, $750,000, and the credit is going to go again to contracts payable, so $750,000 and number 12. Alright, and number 13, the amounts remaining from the other governmental units was received. So we've got a debit to cash for $300,000 and a credit due from other governments for $300,000. We'll note here now that this account is zero. The due from other funds is also zero. And we'll sign off here. We'll pick up in a moment with transaction, let's see, transaction number 14. I guess I mismarked that. 13. We'll pick up with 14. Stay tuned.